Hello, my YouTube friends, and happy Sunday. Geez, I almost said Saturday, right? Today's Sunday, isn't it? I'm so thrown off. How stupid. Anyway, I'm going to go over my 30 set it and forget it stocks that I have in the account that I never really pay attention to. Now, don't get me wrong, I do take a look. I probably make a trade or two every year, but I really don't do a whole lot in it. And I tend to just leave it because I pick companies that I really like. Some of them, like some of the ones I go over in the beginning, might be ones that are, I put a small amount in to take a shot on, and either they'll hit or they won't just because it's kind of fun, but generally they don't. So I really don't recommend doing those. I tend to think it's more important to plow a good amount of money in the stocks you think are the best. And as I go through the percentage of the portfolio that each of the holdings is, I think you'll see what I'm talking about. So I'll start with the smallest and go to the most. I have a total of 30 holdings. I wasn't quite sure how many. I'd actually like to narrow it down probably to 20, but again, some of them I've just started a position in that I want to grow in because I want to rotate out of some of the others. And we'll talk about that as well. I'm also going to tell you if I think they're overvalued, undervalued, or my opinion why I got in them, and kind of talk about it a bit. And you guys can chime in, make comments, let me know what you think about the portfolio. Do you think that some of it's a mistake? Do you think I'm too heavy in one direction? Well, other than my weight, I mean too heavy in terms of, do I have too much of something or too little? All sorts of things like that, or where maybe it could be tweaked. Now, that being said, as always, this is not financial advice. Please don't listen to me or anybody else on YouTube. You really need to do your own research. I know I talk about it all the time, but what works for me may not work for you, even if it's working for me, because you have to talk to a financial advisor, go over your specific position and what's going on in your life to see what makes sense. Or if you're managing it yourself, you have to do the research and not listen to somebody on YouTube. We're all just a bunch of idiots giving our opinion. So the smallest one in the account that's only 0.5% is Loan Depot. I bought them a while back. They actually were implementing a dividend that they never really paid on at the time. Got a little frustrated because the CEO invested, but when I looked at it, he ended up putting less than what he was saying in, and it makes me think that I was probably super early. I still haven't sold it because it's such a small percentage of the portfolio. And I think if they can actually pick up some market share of the mortgage industry, and I don't know, maybe in 5 or 10 years when real estate starts to pick up again and normalize, that they're a good name, kind of like Rocket Mortgage, that they actually may increase their profits and do well and have some of that business. Now, it's quite possible they won't, but I still figure why not? It's a small percentage. The next one is Portillo's, which I talked about a few times. Also a very small percentage in the portfolio. I actually think Portillo's is well valued, if not undervalued. It's 0.7% of the portfolio. But when I invest in a company like Portillo's, it is one that I know it's early on in their career or whatever you want to, their journey. And maybe they don't even make it. But if they do and they can become a significant restaurant, brain fart. I don't even know what the word. But if they could actually have some market share in the restaurant industry and grow across the country, it is so early on. It really could, be a 10x or something like that if I got lucky on it. Now, the next one is only 0.7% as well, and it's Stanley Black and Decker, but it's mainly because I just started to put the position in on the account. I do have a little bit in my, what I call my dividend account, my trading account, separate from my set it and forget it. But I actually hope that Stanley Black and Decker drops a little bit. I think they're undervalued already, but I want to add on to the position. I just started it to have it in the portfolio along with the next two, which is pretty recent, because I'm slowly rotating out of growth stocks into dividend payers because I'd like to work less. I'd like to rely on the dividends a little bit more. And these companies should underperform the market, which doesn't sound like a great thing, but my hope is that they're a little more stable and those dividends just help to pay bills and everything else. The next one is Prudential, which is 1% of the portfolio, and T. Rowe Price. Similar with those, I got in really well with them, but I'd like to see them go lower before I add on. And if they don't, I guess I'll just have too small a position invested in them. Which is also why I end up having 30 stocks instead of 20, is sometimes if I get lucky with the timing, which I assume I don't most of the time. I assume stocks will go lower and I'll dollar cost average into them. But if they end up going straight higher, sometimes I never add on to the position because it doesn't get cheaper, and I end up just having a smaller position than I anticipated, and I don't want to plow in my entire investment from the beginning. I actually do plan on adding number 31. I'm trying to decide, do I buy a little bit now in the set it and forget it account, or do I continue to wait? Because I think they have more downside to come legitimately, which is United Healthcare, but they're not one of the 30. That's going to be number 31 at some point. Um, Next on the list, I have at 1.1% is Lululemon, that I also think is undervalued, but I don't like investing in clothing, let alone women's fashion, because it's so temperamental that it's really tough to predict how it behaves. Men's is a little bit easier. I'll get to Nike in a little bit, but that's why I don't have too much in Lululemon, even though I think it's inexpensive. They continue to be busy. Their earnings are actually pretty good. They seem to be growing just fine, and the stock seems inexpensive to me. They had some bad quarters, but I think that's going to just wane in time and they'll do just fine. They also had some weird thing about some theft that people got all like worked up, blaming Lululemon that they did the wrong thing on that. But when it's a big corporation and they're dealing with problems with theft, there's some tough decisions, and their main decision is going to be the safety of their employees and their customers. So I think there might have been misunderstanding, because if I read correctly, like they punished some employees for contacting the police, and my guess is they put themselves in harm's way, and part of their policy they should know better, but the public seem to take it like, how could you get mad at your employees for trying to do good? Well, unfortunately, doing good is letting somebody take what they've come in to steal and not getting yourself stabbed or shot, or risking a customer get hurt because you try to make things right by stopping them. I know that sounds backwards because it's not right to allow people to steal, but really the safety of everybody is really more important. And if somebody comes in and steals even $5,000 worth of clothes, it's just clothes. It's not somebody getting hurt. At 1.6% is Bristol Myers Squibb, which is another one I think is undervalued, and I'm tempted to add on to it. I've actually owned it for a while, and I watched the price from where I originally bought it go up a good bit and then come all the way back down to where I'm now actually down money. I've had it probably 2 years or something, but I actually think the price looks really good. I think a lot of healthcare looks really good. I think it has to do with like Trump and what's going on, where he's going after them a bit. But I think over time that stuff all like falls to the wayside, and they'll do just fine. And really, when I hear what he's trying to do about lowering the cost of medicine for people, I think that's great for us, even though it's not great as a shareholder of some of the stocks, because potentially it could squeeze their margins. At also 1.6% is CrowdStrike. Now, I got really lucky with the timing on CrowdStrike. My brother recommended it when they were collapsing, when they were going through that whole thing where the planes were having trouble with all of their software because CrowdStrike went down. Picked it up at an incredible price. Actually, the opposite of what I said. Instead of buying a little bit and getting lucky and not adding on, I actually had bought double what I did, but it shot up so far that I got out a half and figured at this point, my cost basis on the little bit that I have now is so little that I just barely pay attention to it. Now, next is Shopify at 1.7%, and it is a good example of why I'll put in 0.5% in something or things like that. At 1.7%, it's actually becoming a little bit of the portfolio, and I put a tiny bit in the Shopify. I got lucky at the timing of it. I think they're a great company. I think they're probably overpriced, similar with CrowdStrike, even though I didn't mention it, but I'm not looking to trade these things. And I bought it as taking a shot. So either Shopify really becomes a huge company and that little bit turns into a good amount of money, or it doesn't. And maybe it just sits and, you know, does nothing in the account. Maybe it goes back down and isn't really much of a company in time. Maybe they get swallowed up by some of the bigger guys and kind of put out of business, but who knows? And like I said, I put little enough. I'm glad that I think it's tripled or quadrupled since I bought it. And if it continues to from here, how lucky is that? Um, I wrote them backwards, like 1 through 30. So I guess 21 going from 30 backwards is Whirlpool, which is 1.8% of the account. They just announced that they cut the dividend after their earnings. The earnings were pretty ugly in some respect. I still like Walmart. After they've cut the dividend, it's still going to be over 4% yield. And when I look at how much money they have coming in, their free cash flow with what the new dividend is, they can cover that pretty easily. Where it was before, it was stretched pretty far. Unless things get worse and the tariffs really hurt them or they continue to slow, which I don't think is going to happen. My guess is that the industry is very cyclical, and during COVID, people bought all the washers and dryers and dishwashers and whatever else that they needed for their homes. So the cycle might take a little bit longer than usual before people need new ones, but I think they will. And even if they're more expensive, at some point when they need the new ones, Whirlpool will stay busy. They're a good name in the space, and it's going to be a short-term hurdle that in a couple of years nobody will notice, and all of a sudden the earnings will be just fine. Next at 20 is Target at 1.8% as well. You guys have heard me talk about Target a million times. I think they're way undervalued. I think they're a great deal. I think anywhere under 100 is a steal. Now, like everything, I could be wrong on this stuff, but man, their PE is so low, even though they've been slowing on their earnings. Their dividend is only like 36% or something. If I'm doing it off the top of my head, so I might be off a little bit, but it's like 36% of their free cash flow, and they're paying 4.5% or something, which is a great yield on a company using that little of their free cash flow with decent earnings, even though quarter over quarter or year over year they had a bit of a slow. There's been so much negative news on the company. Like, I like things like that. What I say is bad news on good companies. Now, Target isn't going to be like an A plus company to me, but they're a good name in the retail space. I also think that they're going to end up starting to compete with like Amazon and Walmart in terms of having like online stores for sellers. That's still going to look like it's Target selling to you, but it could be me or somebody else who's just put their whatever they sell through Target with whatever price they sell it. It's a really good avenue for these companies. They take a percentage of their sales, they grow their business, they can sell all sorts of items because whatever I'm selling, they're selling. Number 19 is Kraft Heinz at 1.95%. It's a bit of a new position. I bought it because, like I said, I'm rotating in the dividend stuff. Kraft Heinz is super boring. I think it's priced fairly. I would say maybe a little bit on the low end just because nobody cares about it. And it's probably a little out of favor while the economy's been chugging along and tech has been what everybody invests in. But it pays a pretty high dividend. I think they'll be fine no matter what goes on in the economy, which is what I like about a company like that. And it's a little bit safer than the money I have in Amazon and Google and the others in terms of the ups and downs. Now, don't hear that the wrong way. Companies like Kraft Heinz really could run into some real difficulties. You just don't know. Next on the list is a somewhat new position that I'd like to pat myself on the back a little bit. I have 2.1% in Nike, but my timing, at least right now, was phenomenal. I think my average price on the share is like $54 and change. I waited a long time watching it drop and drop and drop, and it just finally looked like it had what I used to call on the trading floor the orgasm. When it got below 60, it had all sorts of bad news, and it finally just like cratered down to 52 or something. I don't know the exact low, but as a trader, it looked like a really good opportunity. Now, good chance it pops up to where it did because it had the good news recently, and it could retest those levels even though it's trading up in the 70s. But this is not a company I look to trade. It was paying a decent dividend. The PE came into a reasonable price. It looked inexpensive to me. If it goes back down, it goes back down. And I plan to own it for 5 or 10 years or longer. I mean, I have a philosophy of buy low, sell never. Like I don't really look to sell high, especially in this type of account. My goal is to think of it as it's in a safe deposit box. Like what I hope is I never need that money and I can rotate into dividends and one day my wife and my kid just inherit it. That this stuff just is what it is and I don't actually need to dip into it for anything other than what comes in as dividends. Uh-oh, well, that was no good. Phone overheated. It shut off on me in the middle of it. Let's get back into it. I apologize for that. I was hoping to do the whole thing without even stopping once, but yeah, this thing popped up saying your phone overheated. I guess I got it too excited. If dividend compounders with cheese is watching, my nipples are all hard. Something with my scrotum. He's funnier than I am. I like to watch it. I find that stuff pretty humorous. But anyway, 17, Palo Alto Networks at 2.5%. I love Palo Alto Networks. Every time I watch their quarterly reports and I listen to the CEO, I like what he has to say. About a year ago or so, they changed the way that they report their earnings, and the street hated it. But I like what he has to say. I think them and CrowdStrike, not that I like know the inner workings of these companies, but I think they're the two best in cybersecurity. And I don't know. I guess I should have bought more of CrowdStrike and less of Palo Alto Networks, but I still think they're a great company and nothing I want to sell. In fact, on Friday when they had the pullback in my trading account, I bought a little bit because it looked really inexpensive when it dropped below $170 a share. Number 16, also at 2.5%, is Disney. I've owned them a long time. I've been tempted to get out of it because I don't even know what I think of Disney. I bought them a little bit high. They went down for a while. Now I think I have a small profit in it. I don't think I'm going to sell it. There's just no reason to, but I don't even know that I love Disney all that much. Thing is I saw somebody do an analysis on it, and they were talking about how undervalued it is and how they've projected their next 3 years' earnings and their growth and what they expect out of it, and how undervalued it is based on those growth expectations. And I thought, well, don't get impatient. This is a set it and forget it account. Maybe their analysis on it is accurate, and Disney's Disney. I'm not. What what I don't love about it is I don't think their streaming aspect is all that great. I think they're way behind the others, even though they have some good content. Um, anyway, next on the list at 15, so I guess we're halfway there, also 2.5%, is NextEra Energy, not the one I used to talk about. This is the parent company that I think is a lot safer and doesn't pay nearly as big a dividend. They're the largest energy company. They're out of Florida. I think they run a really good business. It's just kind of a stable, boring stock. Pays a 3% ish dividend. And I think it just continues to grow and does just fine. Number 14 on the list, also showing coming in at 2.5% of the portfolio, is Pfizer. I know a lot of people hate it, and also like Bristol Myers with what's going on with Trump. In my mind, they may get beat up for a little bit longer, but I think it's super undervalued. It's paying like a 7% dividend, and what I hope is that in 5 or 10 years, the stock has drifted up to $40 or so. Nothing that's like hitting a home run, but if I can get a 7% dividend and they don't have to cut that dividend, well, that's great on its own. And if the stock can drift a little bit higher, to me, that's hitting it out of the ballpark, even though it didn't hit it out of the ballpark, if you understand what I mean. Number 13 on my list is a great example of putting a little bit of money in an account and getting super lucky. So when Trump was looking like he was going to win the election, by the way, I do not care. This is not political. I am not making any affiliation of if I like Trump or if I like Kamala Harris. This does not have anything to do with this. It was more that I bought a company because they were going to promote, he was going to put in to director of energy a guy who worked for a company OKLO. They're a nuclear energy company. The stock is losing money. They have negative earnings. I saw nothing good about the company, but I thought if he was getting put in as the Department of Energy, I could take a shot on a little bit of money. I put less than 0.5% of my portfolio in it, and it is now 2.5% of the portfolio. I actually sold some calls, some $80 calls. I bought the stock below 20 or right around $20 a share around the election time. And what? That was November. We're only in August. It wasn't even all that long ago. And it's possible that the calls get taken, which blows my mind away. I'll end up having a half the position and own it with just very lucky. And it goes to show that even sometimes if you put a small amount of money into an account, it really can turn into something. So I wouldn't shy people away from putting a tiny bit that you're not super worried about and something that you could get lucky with, because I consider this something I got lucky with. Now, my plan is, whether I get taken on the calls or not, I plan to sell this no matter what about 6 months before the next election. My theory is by then somebody else will get put in and the stock will have run its course. I don't plan to hold it much longer than that, but that's a good 3.5 year hold. Um, Either way, next one at 3.1% of the account is Caterpillar. I actually think Caterpillar is overpriced right now, and I've been very tempted to sell it in the portfolio and move into something else. The only reason I haven't is exactly what I've said a bunch of times, which is a set it and forget it account. And Caterpillar's a good company. I got nothing against them. So why would I try to time the market? I think they're going to end up having a lot of business over the next few years just because of the California fires. Now, I bought it a while ago, but I was sort of toying with the idea of selling it. And when the fires were going on, and forgive that my brain is so analytical that I start thinking about this stuff instead of just simply worrying about the people in California, which I worry about that as well. But to be fair, I also think about how it impacts the markets. That they're going to need a lot of the Caterpillar equipment to help rebuild the state that wasn't expected. So they may have some decent earnings from some of that stuff down the line, and it's going to take a while to rebuild a lot of that. At 3.4% of the portfolio is Intuitive Surgical, another one that I didn't put a lot in, but I bought it back in like, I don't know, 2020 or 2022 when the market was correcting a whole lot. They are it when it comes to robotic surgery. So I just kind of thought since they're top in the field, and that's what I really like, and I think they have a bit of a moat that it'll be hard for new companies to come in and start competing. Although I'm not an expert in the field, so maybe there are ones coming along. I just feel like they're so far ahead, maybe they can gobble those ones up if somebody starts coming along to try to compete with them. At 3.6% is high yield cash. So I have a little bit of cash in the account. I keep it there to buy something like United Health when I think it'll get to the price that I am hoping. Um, I guess on top of it, the interest rate is like 4.5% on having some cash around, so I don't mind having that anyway. Number nine in the account at 3.6% as well is Cisco, not the food company, the tech one. I've been watching Cisco slowly creep higher over the past year or so. I kind of hope that nobody pays attention and nobody notices. Their PE is not out of control. Their earnings are growing. They've been having good quarters. They made their high back in like 1999 or 2000. A company like that that takes that long to continue to grow, if they make new highs and breach those old highs from 99 or 2000, as a trader and somebody who understands charts a little bit, like a little bit to be dangerous and not enough to really be good at them, it's like look out, the it should just go from there. Like what we're talking about 25 years ago. If it takes another 3, 4, 5 years and it's been 30 years and they finally breach that high, that's an unbelievable sign, and it could mean there's a good ways to go. So I've been really excited about Cisco, even though it moves so slowly and just kind of creeps higher, because I do feel like at some point, if it gets where I hope it is, it's just going to take off. Number 8 in the list is Microsoft at 3.7%. I love Microsoft. I think they're fairly valued. I don't think, if anything, maybe a little expensive, but a company like Microsoft should always be a little bit expensive. They are a moat. They're part of the cloud and the AI stuff. They've got great monthly revenues coming in really consistently that, you know, we all need it. Like we all use it. It's very hard to get away from Microsoft. So I don't see anything changing. And man, if they raise things a dollar or two as a percentage, that's a significant percentage to earnings. So they're in a great position. I think they'll continue to grow. And I just don't see anything changing with them. And they're also really spread out. They're almost like a tech ETF on their own. Number 7, Boeing at 4.6% of the account, which is actually a decent percentage. Now, when I was banging my hands on the table because Boeing was collapsing and they had the planes that crashed, and it finally was looking to me like they were bottoming out, I got a lot of things I don't like about Boeing. It seems like they never get their shit together. Seems like the management is always screwing things up. Like, I hate that stuff. But to be fair, they're an American company that builds planes. When there's a guy who's in office, and I didn't buy it when he was in office, but who's very pro, American business. And I just don't see the government letting Boeing go under. They're not going to get in a position where they have to rely on a foreign aircraft manufacturer to build our planes for all of our for our military, for Air Force One, for all of our commercial jets that fly people all over the world. I know we've got one other and well, maybe a half of one, but Boeing is really the main one, and that's what I liked about it. When I bought it as what I would call a long term trade. I, I don't expect to hold it forever, but I don't expect to sell it anytime soon. I kind of think it's a 3 to 5 year play. When I do feel like it's overvalued, I got no issue selling the shares and actually looking for another opportunity to try to roll that into another trade similar to how I see United Health. I think those companies get really oversold because things get so negative. I mean, I don't mean to talk about it a bunch of times because it's not even one in here, but similar to with Boeing, first you have the fact that the CEO got shot and everybody's on the side of the guy who shot him. Not me, because I don't think it's okay to run around shooting people, no matter how terrible it is. I don't. But that being said, it got such sympathy, nobody liked the company. Then you add to it that they started having bad earnings, which plummeted the stock, and they weren't bad. It just showed that they were slowing down. And then the Department of Justice starts investigating them. And I hate to say it, when the Department of Justice starts investigating you, usually you've done something wrong. Like they don't start investigating and it doesn't become public because they just have an idea. It's that they really think there's something going on. Now, I don't know how bad it is. It might be terrible. They could get penalized to where they may not be able to do Medicare and Medicaid for 5 years. Like it could be a really bad penalty. At the same time, they're the largest healthcare provider, and I don't see the companies who use them caring or getting involved. I think they just continue to use them and use their services. They're like making $16 a share, trading at $240. That comes around to a 15 PE. They're paying a 3% dividend and they grow it rather rapidly. Yeah, I think it's a good opportunity. Now, asterisk. I really think it's probably going to weigh on them for another 6 months to a year, and the stock really could go lower in the meantime. I don't know that now is the time to buy it yet. I own a little bit, and I'm waiting for the opportunity of what I'm looking for. It's hard for me to quantify that, but that's what Boeing was. And now I'm waiting on Boeing, which could go right back down. I don't want any of this heard the wrong way, to hopefully do the opposite. I'm hoping at some point in the next 5 years, they're in the news for a lot of good things. I know they've gotten some contracts already, but I want to see positive earnings and we're growing at this speed and that it feels like it's finally reversed to the other side. And then I want to be able to get out of that and rotate into something else. Maybe it takes 2 years, maybe it takes 5 years, maybe it takes 10 years. Hopefully, I'm alive to see it. But that's what I look for in those, bad news on good companies type of trades. Coming in at 5.1%, and even though it's 5.1%, it is one of my biggest losers, is Starbucks. I've owned Starbucks for a long time. I think my average share price is, I don't know, 116 or $117 a share. So it's up there, and the stock's trading like $90 a share. At the same time, I'm not really looking to trade Starbucks. I like the company. I'm not going anywhere with it. They pay a bit of a dividend, and I figure in 20 years it's still Starbucks. Like, they're number one in their field. I think they have some competitors. I think some of them are coming along strong. But I also like Brian Nichols, who just came on as the new CEO. So even though I think it's overpriced, I'm hoping he's able to turn it around. He was a rock star at Chipotle, and I think he could end up the same at Starbucks as well. Number five. Oh, oh yeah. This is right. At 5.25%, I invested in some weird Goldman Sachs fund. It's a 6 year, like I can't touch the money, I think, for 6 years. But if I understand it correctly, you get the greater of your money back. So if the market is down over the 6 years, you get your investment money back. Or 1.2%, like 20% better return than the S&P. Now, I would have put a lot of money in it. Not that I didn't put a decent amount. If I really thought it was what it says it is, because it sounded too good to be true. So I was a little nervous to put a ton of money into it, because to me, if I can make 20% more than what the S&P does over the next 6 years, or if the S&P is lower, get my money back, that just sounds too good to be true. So something in my mind sounded like something doesn't make sense. I still wanted to invest in it because it sounded like a great fund. I guess I'll find out in 5 or 6 years how it works out. Um, it's 6% or 6.05 is Google. Google is one of my favorite companies. It makes sense that it's one of my top four holdings. Um, I still think they're super undervalued. People are so negative on it. The Chat GPT and all the other stuff they're talking about. Their their search is going to be useless and it's going to continue to drop. Meanwhile, every quarter it continues to do better, and not only does it continue to do better, it does better at faster than 10% growth, which is outrageous for something that's supposed to do worse and worse. And when you listen to the CEO, he talks about like there's space for all of it. On top of the fact that their AI is actually doing really well. So I see potential for them to do a huge part of that industry. Hold on, I gotta hit pause. I gotta make sure the phone's not overheating. Okay, okay, I think we're good. It doesn't feel too bad like last time. Coming in at 6.1% might be my favorite company, and I actually bought a little bit on Friday when earnings came out, which is Amazon. Amazon is just a behemoth. They're really spread out. I've owned it for years, so at 6.1%, I think it's up over 100% in the account, but not because of any genius or timed it that great. Just Amazon's a phenomenal company, and you've got Amazon Web Services, you've got the delivery service that's huge retail. They've got fingers in everything. They've got Prime. There's some things like it kills me that Prime hasn't really competed with Netflix and even YouTube. I'm surprised they haven't gone a little bit of a direction to try to compete with them a little bit better. But Amazon's one of my favorites, which is why the percentage is so high. So number two, at 6.9% of the portfolio, is Chevron. Now, it used to be split in half between Chevron and Exxon. I had a tax event that gave me an opportunity to take the profit in Exxon, and I just moved it in Chevron because I look at them the same way. And Chevron was giving a higher yield than Exxon when I did the transition. When I bought them, they were paying like, I don't know, the dividends were like 8 or 9% yield. So I bought them back in, I'm guessing it was like 2022, and there were negative things going on in the oil industry, and both of them were having all sorts of trouble. I think Exxon was paying like 10%. Well, I had a tax loss, so I was able to take some gains on it. And when I looked more recently and did the rotation, Exxon was only paying like 3.8% total guess, and Chevron was paying over 4%. So my thought was, well, then I'll sell Exxon, I'll move it into Chevron, get the higher yield. I'm able to write off the gains against the losses so I don't have to pay the taxes on it. And I still feel like that I own them both anyway. And what I really intended to do was give it a little time and sell some of the Chevron and move it back into Exxon. I just haven't because it really doesn't matter to me which one I'm in. And I almost like having less ticker symbols than more. But it'd probably be wise to sell half of it and move it back into Exxon. And number one on the list at 18.7%, my top holding is Meta. The scary thing is, over the past 6 months, I've sold 30% of Meta. I just timed it incredibly well. I bought it in 2022 when it fell. My average price per share is $120. I got very lucky with the timing, but when everybody was hating it, I really loved it. I invested a decent amount in it. I kind of regret selling the 30% I did, but it's such a big percentage of the portfolio, even where it is, that it doesn't make sense that I should have that much in the one stock. I only regret it because it's, pushing its all-time highs. So obviously I sold the 30% lower. I actually sold calls. I sold at 500 and then I sold a little bit more recently, but below where it is now. I think I got over 700 a share. But it's an incredible company. And even with the PE ratio being a little higher than its 5-year average right now, I think it's at like 28 and it's normally like 22 or 23. I think the fact that they're growing as quickly as they are, it makes more sense that the PE ratio is where it is now. I don't know that I think it's overpriced. I actually think it's probably fairly priced. I would argue that I think it's a little overpriced, but I actually think this is where the PE ratio should be, and that it was a bargain for a long time, even up until recent when it started creeping higher. So I love Meta. I love that everybody hates Mark Zuckerberg. I think it's a great company, and it is my top holding. I don't plan to sell any more of the shares unless it gets to like 1200, I think is the number where I'd consider selling some of it because I think they're a great company and I think they continue to grow. Anyway, do me a favor, hit that thumbs up button, smash that like button, or if I did it backwards, I did it right twice in the last video, but when I said it just there, it sounded wrong. Make some comments. Let me know what you think about the portfolio. Is there anything that you'd be changing? Do you see anything different? Are there mistakes in there? And this is my set it and forget it account. So keep that in mind. Like I wouldn't do anything unless it really made sense. My trading account now, I do stuff pretty much daily. And then I have a dividend account I barely touched it. Anyway, I hope you enjoyed hearing about the percentage and how I'm spread out, what you think about the 30 companies, and if you think it's a good portfolio. Have a great Sunday. Excited to see the markets open up tomorrow. I got and that's it. Glad to be home.